Corporate finance practice problem using Excel. Calculate multiple bond values. Get ready, it's time to take your chance with corporate finance. Here we are in our Excel worksheet. If you have access to the Excel worksheet and would like to follow along, note that we are in the practice tab as opposed to the example tab. The example tab, in essence, being the answer key. Information on the left-hand side, we're going to populate that into the blue area on the right-hand side, calculating the bond price. The different thing here being that we now have multiple bonds. So that's going to be the added component. Note that we had an entire section focusing on bond price calculations and bonds in general. So you can go back there if you want to do this in a more in-depth way for just normal kind of bond calculations. Here we're going to have a few little slight differences, including this time having multiple bonds that we will be dealing with. If you want to look at present value calculations, which are often tested in textbooks problems related to bonds, and see them done in multiple different ways, including tables and formulas, you can go back to a prior section where we focus in on the present value calculations. Here, we're going to be using the Excel method for the present value calculation. So we have the number of bonds, 92, face amount 1,000, the interest rate of the bond, 15%, market rate is going to be the 11%, years to maturity will be 20, and they're going to be semi-annual bonds. So remember, the new component is this 92 bonds here. What we're going to do is basically take our normal one bond and basically do our normal kind of calculation to get the price, and then we'll simply multiply it out times the 92 to get our total value. So the normal bond calculation will typically be that we're going to take the interest payments, present value that as an annuity, we're going to get paid interest or have to pay interest, depending on which side of the bond we're on. Semi-annually, the calculation of interest will be 1,000 times the face amount of the bond, the 15%. That would be if yearly, but it's semi-yearly, therefore divided by 2. Remember that the interest percents usually represent interest for a year. If the interest is being paid in some interval other than a year, we typically have to do something to it. In this case, divide by 2 for the interest every 6 months. And then we're then having the present value of 1, because the 1,000 will then be paid at the end of the time period at the end of 20 years. So we're going to bring that back to the current time period, and adding those up will be the price of the one bond. And then we'll multiply that out times the 92 bonds to get the total value, the total price. So the normal calculation is going to be the present value of the interest, and then the present value of, we'll call it the principal, the face amount that we're going to have at the end. So it's a little bit more confusing considering we have the semi-annuals, but again, we'll do this fairly quickly because we've seen this in prior sections. If you want to see this in more depth, take a look at the prior section where we'll spend more time on it. But this is going to be the present value, shift 9. The rate is going to be the market rate, the 11%, and that would be for an entire year, but this is going to be for intervals of 6 months. So I'm going to divide that then by 2, so comma, and then the number of periods would be 20. That would be yearly. However, it's semi-annual. Therefore, we have 6-month periods, and we have twice that many, so times 2 for 40 of them. And then, comma, the payment then would be the $1,000 times the interest rate on the bond, but that's the yearly rate, and we pay semi-annual, so it would be that divided by 2. So it's going to be equal to the 1,000 times the 15%. That would be for the year, and then divided by 2 for the 6-month time period. And then we're going to say comma, and actually that's going to be it. We don't need the future value. Let's close it up and then say enter. So there we got the 1,203. Let's add a couple decimals. Then the present value of this 1,000 that would be paid out or received, depending on which side of the bond we are at the end of the 20 years, negative present value, shift 9. We're going to take the rate, market rate once again. That would be for a year. It's semi-annual, so we're going to divide it by 2, comma. Number of periods is 20. That would be years, and this is semi-annual, so we're going to multiply that times 2 for 40 6-month time periods, comma. It's not a payment this time, but an annuity, so 2 commas to skip over to the future value. The future value would be that 1,000 that we're trying to bring back to the current time period. That's going to be the 117. Let's add some decimals. Number group, adding a decimal. So this is going to be the price of one bond, let's say. This will be the sum of those two. And so there we have it. Let's add a couple decimals, numbers, couple decimals, and then we'll have the number of bonds. Number of bonds, and it's going to be 92, or I'm not going to type it in there. I'm going to take it from my data set over here, 92. And then font group and underline. I'm going to put an underline here as well. And that'll give us the total value, which is going to be equal to the 132092 times the 92. And we'll add a couple decimals there, adding a couple decimals. So again, the bond price calculation, standard type of calculations we went over multiple times in prior sections. You can then take a look at that if you want to practice that more and practice that with other types of methods, including tables and including mathematical calculations. The new thing was just tacking on the multiple bonds down here at the 92.